Welcome to the Explainer. The SEC just proposed a rule that's going to make you 50% more blind to your investments. Seriously. Today we're unpacking a massive regulatory shift that is poised to completely alter the balance of power in our capital markets. We're looking at the potential end of the mandatory quarterly earnings report, and we need to talk about what that actually means for every single person who interacts with the stock market.
So ask yourself, what happens when the market takes away half your visibility? We are facing a structural change that threatens to widen the already massive gap between everyday retail investors and the big institutional giants. By halving the frequency of corporate financial reporting, we aren't just cutting paperwork. We're entering an era where your speed and your access to alternative data will literally separate the winners from the losers.
To really grasp the gravity of this, we have to look all the way back to 1970. Since 1970, following the Wheat Report, mandatory quarterly reporting on Form 10Q has been the absolute gold standard for public markets. It provided this crucial forcing function that compelled corporate transparency and strictly limited the duration of information asymmetry. But now, that 56-year era of transparency is officially on the chopping block.
Okay, let's map out exactly how this systemic shift is structured. We're going to cover the end of transparency, the information dark ages, the rise of alternative data, the new options market, and finally, why you need to beware the zombie companies.
All right, part one, the end of transparency.
So this whole thing stems from the Make IPOs Great Again initiative, and it's actually garnered bipartisan support, backed by figures like former President Donald Trump, as well as corporate leaders who really want to reduce short-termism in the markets. The core of the shift is moving from the rigid mandatory 4 times a year Form 10Q to an optional twice-a-year Form 10S. Basically halving the public data you receive to save companies a relatively tiny $198,000 a year in compliance costs. But critics are warning that this meager savings comes at the massive price of sacrificing rapid price discovery.
Moving on to part two, the information dark ages.
The crucial point here is that this 6-month delay creates these massive dead zones, and that is exactly where predatory alpha thrives. In these dead zones, we face the severe threat of what's called phantom liquidity. During stable periods, high-frequency traders, HFTs, provide a ton of trading liquidity. But the exact second the market struggles to process a highly complex, delayed 6-month report, those algorithmic traders just yank their support. That liquidity is a phantom. It vanishes right when everyday investors need it most, which severely amplifies price crashes.
Because look, these HFT algorithms, they operate in fractions of a single second, microseconds, just to exploit tiny scraps of data. This is pure latency arbitrage. They identify attractive prices and execute trades before a human investor can even finish reading a headline, let alone do the math. Without our traditional quarterly anchors to ground the market in fundamental reality, these algorithms are just going to run wild, causing extreme intraday swings.
Let's break down the mechanics of this. Without that quarterly check-in, HFTs exploit market uncertainty. The data shows us that a 10% bump in HFT activity leads to an annualized volatility increase of 3 to 6%. And because there's no firm-specific data coming out, stocks suffer from price synchronicity, meaning they just move blindly with the broader market. HFTs capitalize on lead-lag mispricings. They essentially react to tiny market ripples in related assets before you do, effectively front-running retail investors before that public 10S filing ever hits the wire.
Which brings us to part three, the rise of alternative data.
If the official SEC filings go totally dark for 6 months, how are the institutional Goliaths getting their data? Well, they pivot. They pivot straight into the $73.5 billion alternative data market. While retail investors are sitting on their hands waiting for an official form, institutions are using daily satellite imagery of agricultural yields or retail parking lots. They're scraping weekly credit card transactions to track wallet share and using daily geolocation footfall to monitor industrial activity. They just bypass management spin entirely by measuring the raw reality of the business in real time.
And to actually process this absolute fire hose of information, funds use what are called agentic ETL pipelines, extract, transform, load. Costing up to $1 million per billion in assets under management, these AI systems scrape unstructured web data, they monitor e-commerce review score declines, and they instantly spot plunging job postings. They use all this to nowcast revenue misses months before a retail investor is ever alerted by Form 10S. Okay, part 4. Let's look at the new options market.
Now, what's really fascinating here is how this 6-month shift fundamentally rewires options implied volatility around these rare reporting periods. Because the new 10S covers 6 full months of dense, complex data, it creates this massive hump-shaped uncertainty curve. A standard quarterly 10Q is relatively easy to digest, but when a 10S finally drops, implied volatility actually spikes harder and stays elevated for up to 4 weeks post-filing. It takes the market weeks longer to resolve the uncertainty and digest a half year's worth of corporate data, which heavily distorts the variance risk premium. Bottom line, options get significantly more expensive because the risk of a massive surprise is so much higher.
Finally, part 5. We need to talk about the zombie companies. Because the absolute most brutal truth of this explainer, and honestly the biggest risk to the everyday investor, is how this semi-annual shift shields basically insolvent zombie companies that are rotting from the inside out. Shockingly, nearly 11% of the Russell 2000 falls right into this category. These are businesses with an interest coverage ratio below 1, meaning their operating profits don't even cover their interest payments. They are struggling with massive floating interest rates that have jumped from 4% to upwards of 15%. Yet, without quarterly checks to reveal this internal collapse, retail investors are going to remain blissfully and dangerously unaware of their rapid deterioration.
Let's put this on a timeline because it creates a catastrophic asymmetric situation. Imagine the last piece of public data hits in January. By June 30th, the private credit market goes through a mandatory reckoning to revalue holdings. Institutional shadow banks and insiders see the real-time internal data, and they quietly head for the exits. But the retail investor, they're left completely in the dark, holding the bag for 5 more months until they finally receive the delayed 10S filing in August, long after the stock is cratered.
Ultimately, this regulatory shift destroys the level playing field we've relied on since the 70s. It replaces a predictable rhythm of transparency with a Wild West where alternative data is king. So, as we wrap up this explainer, I want you to really ask yourself, when the market inevitably plunges into this information dark age, how are you going to secure your data before the rest of the herd? Keep analyzing, stay sharp, and I'll catch you in the next explainer.